potentially we're looking to trade futures. There's two ways we can get information or make decisions on potential trades that we're going to place as traders. And let's just move that. We'll move the monitor over as well. So our first kind of way in which we can get information is fundamentally. So as traders, we can read news reports, we can do some investigation into companies and see how they're performing if we want to look at purchasing their shares of a company. So if we like the look of gold, crude, silver, or we don't like the look of any of those commodities, we can potentially look to take a position on those on the basis of fundamental analysis. So we might see that, for example, there's been a massive shortage of globally of gold, and we feel that because of the current state of the economy, gold looks as though it's going to potentially move higher. And we know that when the economy and the global economy is starting to be threatened, there's real value in gold because people view that as a flight to safety asset. So what we might see is increased buying in gold. Now, if we're speculators, because remember there's two types of potential traders. There's speculators and hedgers. If we're speculators, then we might be speculating that gold might move up, and based on our fundamental analysis of the global market and the general supply and demand of gold, we might decide we want to buy gold at its current price and hold that commodity for a while and see if it actually moves higher, at which point we could potentially sell it. So really, we've got two ways in which we can trade. We can either trade off the news fundamentally. We can look at, as I said, we can look at the strength or weakness of a commodity, a company, and we can make a decision based on that. Or we can trade technically. Now, technical analysis. Has anybody heard that term before? Technical trading, technical analysis? Well, technical analysis is really just trading based on the price that is reflected on your chart. So, as I mentioned before, when we talk about charts in the room, and we talk about that a fair bit, we refer to our charts. This is just basically a chart. You've got down the right hand side, you've got price. Down the bottom, you've got time. So you've got time down the bottom, and up the right hand side, you've got price. So what's happening on this chart is that it's printing the current price. If you have a look at the top of your chart here, you'll see that it's CL, which is the abbreviation for crude oil. It's showing 5 minutes worth of price action per bar. So each one of these bars here, this is what we call a bar. And now a bar is, and I'll just make this a bit wider, and so each one of these vertical lines is what we call a price bar. So each price bar has a low, which I'll mark here. That's the low point there, and we'll just mark that there. Move that over there. So there's the low point down there. Each bar has a high, which is the very high of the bar. We have on the bar what we call the opening price, which is the left-hand line, that small line there, and then we have the closing price, which is the right-hand side here. So basically, the bar is made up of four key elements, or four key components. We've got the high, which is the very highest price that that price travels on that 5, because each bar is 5 minutes of action. There's the high. Then we've got the lowest price. Then we have the open, and then we've got the close. So let's pick another bar to demonstrate that. So we'll pick one that, okay, so here's another one. So you can see here that there's the low, So we've got the low, we have the high, we have what we call the open, and we have the close. So let's position those correctly around the bar chart. So if we're looking to mark our chart up, that would be the low price there, the very bottom price there. Now if I bring up what we call a data window, so the data windows are important because they tell us exactly what all the figures are on the chart. It's very hard to see what the figures are by just trying to line those up with this axis here, this left right hand axis. So what we do is we can put our what we call our crosshairs or our cursor on that bar, and you'll see that it says the opening price of crude on the 22nd of February was the open was 97.45, so that's what price it was on that at that 5-minute mark. The high was 97.51, so it actually moved 6 points higher. The low was 97.22, and the close was 97.24. So it had 210 up transactions and 227 down or negative transactions that made up that price bar. So for that entire 5 minutes of trading, that was the exact range of crude oil at that time. Now remember that this chart is of crude oil, so it's basically going to be trading 24 hours a day. It doesn't stop crude, and it just constantly trades and trades and trades. Now, all we're looking at here is what we call price. This is called price action. So remember, there are two ways to view or make decisions based on trading. That's technical. So let me just move that over so we can see it. I'll just get rid of that. So there's technical and fundamental. Now, we basically want to make sure that we really want to just trade in this area here. We want to be fundamental traders. So technical traders trade on what we call price, volume. So price and volume basically is what technical traders base their decisions on. And that's it. So it's price action and volume. Now, what we're going to discuss tonight is basically price.